Chapter 4, Audit Planning. In this chapter, we are going to talk about the stages of audit processes. During the audit processes, the activities of the auditor can be gathering in 4 stages. These are as follows. The first one is accepting the engagement and arrangement. The second one, audit planning. And the third one, performing audit procedures. And the reporting of findings. So the stage of audit process, due to the risk-based audit approaches, the audit process consists of 3 stages, also referred as 3R audit. The first one is risk assessment, the second one responding to the risk, and the third one is reporting. Also, we talk about these 3R processes in chapter 3 in a detailed way. Paying attention to the planning stage in the audit will help to achieve success in the audit. Planning is a continuous and a repetitive process rather than being a one-time job. First of all, client acceptance. The client acceptance, the audit proposal received by the audit firm, is first evaluated by the managers of the audit firm, and then if the parties agree, then the engagement phase is started. The process of evaluating the proposal from the client includes the process of evaluating the proposal from the client includes the assessment to be made about the client's business and the assessments that should be considered with its ethical dimension. These are as follows. The first one is evaluation of the client businesses. In practice, the audit firms determine the risk level of their clients with the test they developed and decide whether to accept or continue the audit accordingly. The second one, ethical evaluation. The audit firm should consider its own business risk when accepting the proposal. Audit engagement with client. If we decided to accept the client, now we will gonna prepare audit engagement letter and we will gonna sign together. In this stage, according to international standards of audit, an audit engagement letter must be created between the audit firm and the client to solidify the audit arrangement. The engagement letter must be signed by the authorities of both parties. The main points to be included in the audit engagement letter are listed below: purpose of the arrangement and audit period, the responsibility of the business management regarding the financial statements, audit standards to be complied by the auditors and the scope of the audit, and audit fee such as billing, compensation condition, so on and so forth will be exist. After the audit engagement, now we are going to prepare audit plan and audit strategy. The audit strategy is a general approach to the audit engagement, which is the specification of the detailed audit plan, the scope and the performance of the audit. The audit plan regulates specific audit procedure such as risk assessment and details of the structure, scope and timing of the work that will help the auditor to form an opinion. The auditor creates the audit plan in accordance with the audit strategy. The plan includes risk assessment procedures, structures, time, and the scope of further audit procedure. Both the audit strategy and the audit plan are changed and updated when needed during the audit. Audit plan. For the audit plan, we need to give some attention. The attention is drawn to some priorities in the audit plan. Examples of these priorities are understanding client business and industry, identifying clients' business risk and fraud risk, implementing preliminary analytical review procedures, audit risk assessment, determining the materiality level, understanding the internal control system. So let's talk about the understanding clients, business and industries. But you must understand that this is not the acceptance. We must understand that this is not the accepting level. We already accepted the client. We already signed the audit engagement letter. Now we are in the company, client company. So we are going to now try to understand the client, business and industry in a detailed way. So we become an auditor of this firm. In that stage, this is the first stage of the audit planning. We must understand the environment of the client. So what am I gonna do here as an auditor in that stage? We will understanding a client business, activities, practices, and their impact on financial statements will help audit procedure to be implemented both in the planning phase in the first stage. Understanding a client business, activities, practices, and their impact on the financial statements will help audit procedure to be implemented both in the planning phase and in the future. If the client is new, the auditor should especially learn about the following issues and also take into account the impact of these issues on the financial statements. These are as follows. The first one is the sector and the environment of the business, goods and the services produced in the entity, last financial position and the performance of the businesses, business activities and the business processes. After that, we are identifying client's business risk and the fraud risk. The auditor should try to identify and assess business risk and fraud risk that will lead to material misstatements risk in the financial statements. Client business risk, it is the possibility assessment of the client not reaching its business objectives. Fraud risk, which is a corruption, in order to gain an illegal advantages or derive and improper fraud risk, which is corruption, in order to gain an illegal advantages or derive an improper personal benefit, the possibility of one or more individuals from the management level to perform an intentional action with administrative staff, employees, or third parties is called fraud risk. So, fraud risk is important for the auditors because when we talk about the risk-based approach in audit, the risk means frauds. We are concentrated in the fraud in the businesses, in the firms that we are setting up our process in that, our audit process in that way. Fraud in businesses are classified into three categories. One is misappropriation of assets, which also call it employee fraud. Another one is fraudulent financial reporting. And the last one is corruption. In the process of understanding the client businesses, in the process of understanding the client businesses, the auditor tries to recognize the relationship of business and fraud risk with the financial statements and the measures taken by the management against such risk. How the management will take the place in that case? Of course, with the internal controls. The management will create the effective and efficient internal controls to protect the firms from these frauds. So, on the third stage, we are implementing preliminary analytical review procedures. We also talk about in a detailed way how the analytical procedures will apply during the planning stage in the chapter 3. Analytical review procedures, these are the evaluation studies conducted to investigate the logical relationship between the financial and non-financial data. The objectives of the auditor to benefit from analytical review procedures are to understand the business and the sector in which it operates, to evaluate the sustainability of the business, attracting management's attention to expected misstatements, to reduce the number of the detailed tests. So these are the objectives of the auditors to benefit from the analytical review procedures. Now I'm going to talk about that another stage, audit team, determining whether outsourced specialists are required. Audit team means also these audit teams, I'm going to move to audit strategies. With these teams, help me to establish audit strategy also. In order to increase the effectiveness of the audit, it is very important to assign an appropriate audit team that knows the client's business and the sector in which it operates. According to international standards of audits, it is obligatory to form an audit team consisting of 6 persons, at least 3 originals and 3 backups for each audit works. During the audit, external expert can be appointed if needed. In this case, the auditor needs to know the specialist qualifications and whether there is a relationship with the client businesses. Why? Because we need to concentrate it also independency from the code of the ethics, which we talk about in chapter 2. Audit risk assessment. This is the next step in audit planning. Audit risk is the possibility of encountering significant misstatements in the financial statements, although the audit has been completed and an unqualified opinion is issued. The auditor wishes to keep the audit risk level low. That is, the auditor wishes not to express an unqualified opinion, although the financial statements contain material misstatements. In order to reduce the audit risk, the auditor needs to understand the client business, the sector in which it operates, management of the business, get to know the situation and activities in terms of the legal and the financial aspects, and learn the purpose of financial information users. This is a very important topic for the audit. Components of the audit risks. What are these? We are already talk some of them in chapter 2, but I will talk about little bit in a detail way in this chapter 2, because the assessing the audit risk is the main stage of the planning part. Components of the audit risk, or in other words, the audit risk model includes 3 different types of the risk. These are inherent risk, control risk, and detection risk. According to audit risk model, the auditor uses the formula below to determine the detection risk and the number of the evidence to be collected. So when we calculated the audit risk, of course, there is a model that inherent risk multiply control risk multiply detection risk. But from the detection risk, we need to separately calculation of the detection risk. Detection risk, acceptable audit risk. It also inherent risk multiply the control risk. So these are the detection risk, it brings us acceptable audit risk divided by the inherent risk multiply control risk. This is the formula that we are calculating our detection risk in the audit work. This is really important because these calculations will help to us the number of the evidence to be collected as an auditor. So what are the meaning of what is the definition of these type of the risk? First of all, let's talk about the inherent risk. Inherent risk comes from the environment of the client firm. So it is the evaluation of the It is the evaluation of the probability of material misstatements in account balances or a class of transaction, regardless of the effectiveness of the internal control. Inherent risk. It is the evaluation of the probability of material misstatements in an account balance or a class of transaction, regardless of the effectiveness of the internal control structure. Control risk is a function of the effectiveness of an internal control designed for financial reporting. It is the auditor's assessment of the probability of failure in the client's business internal controls to prevent or reveal the misstatements in an account balance or class of transaction that exceed the acceptable limit. Detection risk means the probability of an auditor to miss misstatements in the financial statements of the client's business with the collected audit evidences regarding the account balances is called detection risk. So, inherent risk and control risk come from the client firms. Detection risk is coming from the auditors. Therefore, detection can be manageable, and the control risk can be manageable if the company management, client management will be work with you in a close way. But inherent risk, it cannot be manageable. How much you measure it at the beginning of the audit works that you will accept until end of the audit work. So this is the important risk concepts for us during the audit stage. Detection risk, as I mentioned it before, it comes from the auditor, because as an auditor, sometimes, I don't know, maybe you are not qualified or you don't have enough knowledge about the firm, about the sector, then you can face with detection risk. So let's talk about the detection risk in a detailed way. Detection risk depends on other risk factors in the audit risk model and affects the number of supporting evidence that the auditor will collect. If the detection risk is low for the classes of the transaction or account balances, the number of evidence to be collected will increase. The auditor tries to determine the real level of detection risk by paying attention to following points: appropriate planning, guidance, surveillance, and inspection, determining the structure, scope, and the time of the audit process correctly, performing audit procedure effectively, and evaluating the results. These could be affected decrease of the detection risk for the audit works. So the next step for planning, determining the materiality level. Materiality is also important concept in accounting. It's also important concept for auditing too. So let's see what does it mean in accounting. Materiality in accounting. If hiding or misrepresenting information can affect users who will make their economic decision using financial statements, that information is material. In that definition, can affect users is the important point of these definitions. We have to be really careful about that. The auditor should try to reveal not all misstatements, but material misstatements that may affect the financial statements and correct them. If the client business is not willing to correct mistakes, the auditor should express his opinion accordingly into audit report. So this is the auditor side of the materiality. So main materiality level types are the A. Materiality at the financial statements level. B. Materiality at the account balance level. C. The tolerable misstatement level. There are three important type of the levels in materiality. The method used is determining the preliminary materiality level is to take a certain ratio of various sizes as a benchmark. For example, 1% of equity capital or 0.5% of total assets or 2% of gross profit or 0.5% of sales turnover. As an auditor, if you wanna determine your materiality level in as an auditor, if you wanna determine your preliminary materiality level, so you can take one of them or two of them as a criteria, then you can determine your materiality level. These are the example that you can use it in your audit work. Another step in the planning stage, understanding the internal control system. Internal control system is very important because internal control system is the response of the business management to risk, which means business management is responsible to establish an internal control system. Not really establish. Every company, every firm has an internal control system, but some of them are strong, some of them are weak. Strong means the system works effectively and efficiently. Weak means the system is not really working effectively and efficiently. So that is the differences between the internal control system has a strong system or has a weak system. Why is important for the audit and for the auditors, this internal control system weakness or strong part? Because when I understand what kind of internal control system the company has, that I will make my audit plan according to this understanding issue. Internal control system serves for primary purposes in a business. And these are increasing the reliability of the company, ensuring compliance with the legislation, providing accurate and timely financial reporting, contributing to operational efficiencies. So there are four main aim to establishing internal control system in the companies. Internal control system consists of 5 parts. One is control environment, risk assessment, control activities, information and communication, and monitoring activities. There is like 5-leg bridge. If one leg is missing from the bridge, that you cannot prefer to walk it. Therefore, all these 5 must be exist. There is no exception about that. In an effective audit practice, the auditor should first get to know the internal control system, then evaluate the control risk, and then accordingly determine the nature and the scope of the audit procedure. So this is how related each other you can understand. If the company has an effective internal control system, the client, which means the control risk level will be low. So as an auditor, I will determine the nature and the scope of my audit procedure. If it's a weak, which means control risk level is really high, so I can collect more evidences. I will accumulate the more accumulated evidences. So I will accumulate more evidences if it's a high control risk level exists, which means as an auditor, I'm going to extend my audit procedure for these audits. So now I am going to talk about the chapter 5.